In this lesson, we will be learning the basics of Forex pairs. If you're new to Forex trading, understanding the basics is crucial. First things first, what is a Forex pair? A Forex pair or currency pair is a quotation of two different currencies where the value of one currency is quoted against the value of another, facilitating trading between different currencies. A Forex pair consists of two currencies, for example, Euro-USD. The first currency in the pair is called the base currency, and the second one is the quote currency. In our example, Euro is the base currency, USD is the quote currency. When you see a quote like 1.0697 US dollars for Euro USD, it means 1 euro of the base currency is equal to 1.0697 US dollars of the quote currency. Remember, there are two sides to every trade. When you buy a currency pair, you're essentially buying the base currency and selling the quote currency, and vice versa when selling. So if you open a long position on Euro USD and it moves from 1.2050 to 1.2051, that's a gain for the buyer as the euro appreciates, but a loss for the seller as USD depreciates at the same time. This movement from 1.2050 to 1.2051 is of 0.0001 US dollars. That's where pips come in. A pip is the smallest price movement in a currency pair, typically the fourth decimal place in a currency pair. This is an exception for yen pairs, which use the second decimal. So, if you open a long position on Euro USD and it moves from 1.2050 to 1.2051, that's a gain of 1 pip, 0.0001, which is the smallest price movement for a Forex pair. Understanding pips is essential because they help you measure price changes and potential profit or loss. Now, let's talk about lot sizes. In Forex trading, a lot refers to the size of a trade. There are 4 common lot sizes. Standard lot, 100,000 units of the base currency. Mini lot, 10,000 units of the base currency. Micro lot, 1,000 units of the base currency. Nano lot, 100 units of the base currency. Choosing the right lot size is crucial as it determines the level of risk you are taking. Larger lots means higher potential profits but also greater risk, while smaller lots allow for more controlled and manageable trading. You can determine how much you will profit or loss on every pip movement by calculating the pip value. Pip value equals pip in decimal places multiplied by trade size multiplied by pip exchange rate. Let's say you're trading 100,000 units of Euro USD and the exchange rate is 1.2000. To calculate the pip value, we plug in the numbers. Pip value equals 0.0001 multiplied by 100,000 multiplied by 1.2000, which equals $10. So for every pip movement in Euro USD with a trade size of 100,000 units, the value changes by $10. When calculating pip value, you're determining how much of the quote currency will change hands for a 1 pip movement in the exchange rate. This means that if you're trading Euro USD, where the USD is the quote currency, the pip value will be calculated in USD. Similarly, if you're trading USD JPY, where JPY is the quote currency, the pip value will be calculated in JPY. To convert this to USD, you can simply divide the pip value with the exchange rate of USD JPY. Remember, understanding pip value is essential for risk management and profit calculation. Now that you have a better grasp of Forex trading fundamentals, you can approach the market with confidence. Happy trading!